Mr. Mark Douglas in his book, The Disciplined Trader. After extensive research that he conducted, he has a very beautiful statement about the market, saying that his theory is this: 80% of the financial markets is about psychology, and only 20% of financial markets is about technical analysis. Okay, so the 20% that's about technical analysis is fine. That's 100%. We guarantee to be by your side and teach you in an incredibly simple and practical way. But what does that 80%, the psychological aspect or market psychology, refer to? This is the part we really need to focus on when we recognize our own feelings and emotions. We need to be able to handle the market, decide how much money we put into it, determine the amount of capital we're going to invest, and the way we trade, all of these things. What effects does this have on our mind and psyche in this course? We're not just going to work on technical analysis with you or simply review some technical principles. Of course, we will do this and provide you with excellent technical analysis, but more importantly than that, we intend to include sections on financial psychology, personal psychology for trading, music and the psychology of excitement, and trading psychology. In addition to capital management, which is a fundamental point in financial markets and is extremely important, sometimes we may have good technical skills and a good understanding of our own psychology. But if our capital management isn't good, this lack of proper capital management can lead us to incur irreparable losses in the market. Guys, let me explain something to you here like this. When we're trading, if we're losing money, if we lose 50%, we have to make 100% profit just to get back to our original capital. For example, if we have $10,000 and we lose $5,000 of it, in order for that $5,000 to become $10,000 again, we have to make a 100% profit on the $5,000 just to get back to $10,000. That's why they say capital management is important. It prevents us from falling into a deep hole. It doesn't let us go that far down, so that the climb back up isn't so exhausting. We have the same concept when it comes to profits as well, compound interest, which is explained in detail in the course and how it works. If we're making a 10% profit and our initial capital is $10,000, first we reach $11,000. That is $1,000 profit on $10,000. We've made a profit, but the next month we're earning 10% on $11,000, so the next month we have $1,100. We're earning profit on 10, 11, and then $11,100, and this keeps compounding and increasing. If our goal is to make $1,000 profit from the market each month, only in the first month do we need to make a 10% profit. The next month it's 9%, the month after that 8%, and it keeps going down. Why? Because our capital is increasing. But in the same way, when we're losing, to make up for a 10% loss, we have to make about 34% profit. For a 20% loss, we have to make a little over 30% profit, and for a 50% loss, we need to make 100% profit. So we really emphasize this capital management, and it's part of the 80% psychological aspect, which is about dealing with those losses. The amount needed to recover from different levels of losses can be managed with different mindsets. That is, if we keep our losses small, it's much easier to make up for them. But when the losses get bigger, the psychological aspect comes into play, the excitement, or as we say in everyday language, wanting to enter the market with a sense of revenge. We want to take revenge on the market, thinking, why did you take my money? I'll get it back from you. But that's not how it works. We always need to remember one thing, guys. The market is stronger than we are, so we should never try to go head to head with it. Because the one who gets emotional is us. The market acts intelligently. Maybe you've heard that in a negotiation when someone wants to win, or in an argument when someone wants to come out on top. They say, make your opponent angry. They'll make a lot of mistakes, their decisions won't be rational anymore, and we never let that happen to ourselves. The market tries to make us angry. It does this with our capital so that we get angry and want to react. We end up putting aside all our knowledge, techniques, and proper trading methods and enter the market seeking revenge. We just sit at the bottom of the market. That's why we have a set of target limits and capital management plans for daily, weekly, monthly, and yearly periods. Based on those, we can manage ourselves, manage our accounts, and always monitor our performance so that we don't get caught up in the trap of becoming a fighter in the market. We don't fight with the market. We don't play the warrior with it. In fact, the market is our friend. It's our companion. The market supports us and wants us to profit. So for this reason, we're going to implement a really good technique. Let's learn excellent psychological management of the market. Plus, combine it with outstanding capital management, and then in the market, all of you will be winners. Look, guys, capital management isn't just supposed to be applied to the budget we've brought into the market and are trading with. Of course, when it comes to the money we have in the market, we need to manage our capital for each trade. But since market psychology tells us that this budget itself should have already been managed in our lives before entering the market and only then brought in, what does that mean? It might be a bit confusing, so I want to expand on this topic. Beforehand in our lives, we need to calculate how much of our total assets we've set aside for safe assets. What are safe assets? Things like housing, land, a home, or anything else similar, assets whose security is guaranteed. We know very well that in Iran, property prices generally don't go down. They might fluctuate a little, but over time, real estate always appreciates. It might stagnate at some point, but unlike the dollar or stocks, it doesn't experience sharp declines. So that's what we call a safe asset. Another type of our assets are those with high liquidity. That's really interesting. What does it mean? It means that assets with high liquidity, like the dollar or foreign currencies, for example, euros, Swiss francs, stablecoins, or gold, in its various forms, we can consider gold as a highly liquid asset. Meaning, whenever we want, we can liquidate these assets. But real estate is a safe asset, though it doesn't have high liquidity. Meaning, if I ever need money, I can't just say, okay, I'll auction off 2 square meters of my property or sell 8 of its bricks. That's just not possible. Either I have to sell the whole thing, even though it's my safe asset, or I can't liquidate it or access its value, liquidating that property for financial purposes. My asset isn't very large, but as we said, we consider real estate as a safe asset. And we consider gold, dollars, and foreign currency as safe assets with high liquidity. Meaning, whenever we want at that very moment, we can access their intrinsic value instantly. They provide immediate liquidity for us, unlike some of our other assets. So what are we doing now? We're managing our investments across our total assets. Now we've set aside the safe assets. Alongside the safe assets with high liquidity, we've set those aside, and now what do we look at? We look at the assets where we're allowed to take risks, where we have permission to take risks with these assets. Meaning in this way, we can enter investment markets such as digital currencies, holding and maintaining them, or certain cryptocurrencies, or we can engage in trading within the stock market. Also the international stock market. Now, where does the risk in these markets lie? The risk in these markets depends on the level of knowledge we have and how we want to proceed. To reduce the risk in these markets, we need to increase our knowledge. The more comprehensive and practical our knowledge is, the less risk these markets pose to us. But if God forbid, for any reason, let's say something happens to this account, our lives won't be affected. Basically, we're working on our trading psychology, and we're reaching a point where even if something happens to this capital, God forbid in the worst case scenario, we haven't lost all our assets, our lives haven't been affected, we've maintained the stability of our lives, and now, from here, we begin. With the increase in knowledge that we gain in a practical, scientific, easy, fluent, and simple way. In this course, we can manage the risk level of the capital that has entered the financial market. So now, for example, let's say I had 100 million in cash, or for instance, I had 1 billion in cash. Out of that 1 billion, I put 50% into my assets, and I put 20% into high liquidity assets. I put 10%, for example, into buying a car for myself. Another 10%, which would be 100 million out of 1 billion, I bring that 100 million into the market. Now here again, we have a new capital manager. Now it doesn't mean that this entire 100 million will be put at risk in a single trade. Well, since I've managed my capital, even if it goes away, nothing happens. I still have my house, my car, and my high liquidity assets. No, the point is, if something is going to happen to this 100 million, why should it be in a single trade? Why not in 100 trades? Why not in 1,000 trades? Why was it tested in demo beforehand so that this doesn't happen? Now, after doing all this, we bring this 100 million into the real market. Now, the second level of capital management means we're managing our capital relative to our trading account. That is, the amount of risk we accept in each trade compared to the reward or the profit we want to make. How does that work? Let me explain. Let me clarify this a bit. As an advisor, as a friend, as a buddy, I'm telling you, for example, Ali Morteza or whoever you are, I'm telling you honestly. Whatever your name is, I'm telling you that we want to make a trade together. We want to go and make a trade together. So the first question we ask is, how is the profit? How is the risk? I say in this trade, for example, we're supposed to invest 50 million. It's possible we could make 10 million in profit, but it's also possible we could lose the entire 50 million. So they say, isn't this deal unreasonable? In fact, at that moment, subconsciously, you're managing your capital. You're saying, I don't accept the risk to reward ratio of this trade. The risk is 100% of my assets, while my profit or reward is just 1/20th of that, 10 million. You say, no, I won't take this trade. Now, do you change the game? I see it and make a suggestion. I say, look, we're supposed to take 50 million, 100 million, the money we've made in the market. For example, let's use 10 million of it. Let's take a risk, make a trade that could potentially give us 30 million in profit. This is a bit more logical. First of all, I'm only putting 10% of my 100 million into the market. In this trade, I'm aiming to get a 30% return on that 10% portion. And even if I lose it all, it's only 100% of that 10%, not all my money. 10 million out of my 100 million is still a significant amount of capital. In the market, we often see even more impressive amounts of capital. We risk about 1% of the account, risk 1%, take 3 to 5% profit, and let the trades play out. Let me give a more comprehensive example. Let's say in this scenario, we make 10 trades, and in each trade we risk 1% and make 3% profit. So for example, I do it like this once. Let's say that 5 of these trades end up as losses and 5 of them are profitable. So in those 5, in the trades where we lost 5 times 1%, so we lost 5% overall. And in the 5 trades where we made a profit, we earned 5 times 3%, so we gained 15% profit. Well, here it's just a very simple subtraction. We lost 5% and we gained 15%. We subtract one from the other, so we're up 10% overall. We called it a 50-50 game. Now, let's even make this game a bit more biased toward heavier losses. Let's say, for example, we had 7 losing trades. So when you have 7 losing trades, you've lost 7% of your capital. You only had 3 winning trades. Each of those 3 trades brought in 3% profit. So you made 9% profit. 7 minus 9, you're still 2% in profit. This is where you see how capital management and market psychology can make you more successful than just technique alone. If technique was really that different, it shouldn't be like this. We had a losing week with 7 losses and only 3 wins, but what saved us here? It was our capital management that saved us. Despite 7 losing trades and only 3 winning ones, we still ended up with a 2% profit. So this is what happens. But here we'll go into capital management in much more detail. We'll cover it again in the capital management section, but I just wanted to give you a brief overview now. We need to have capital management, which consists of 2 parts. First, before entering the market, and second, the assets we currently have. Second, it's about the money you bring into the market, and I strongly emphasize this. Guys, the money you put into the market should be a percentage of your surplus capital, not that. You shouldn't go and sell your house, you shouldn't go and sell your car, and you shouldn't go and take out a loan. If you take out a loan and bring that money into the market, then trading will put so much pressure on you that you'll never be able to apply the right techniques, never. You won't be able to get a proper return from that money because with every trade you want to make, when you press the buy or sell button, and the amount of risk you take on comes with a commitment behind it. This money is a loan, and if it comes with its own story, this car was under my feet. If it's lost, what will happen to your life? The amount of external pressure increases so much that it overwhelms your mind and doesn't let you make a proper trade. So we're going to talk about this topic in detail and in the consultations given to the students. With the support provided, we can even assist each individual personally so that based on each person's assets, we can manage their capital accordingly. All right, guys, now that we've taken an overall look at the market, we need to take the first steps to enter this market. Together, for entering this market, first we all need a brokerage where we can open a trading account, set up our trading account and the platform so that we can start our trading activities. Running our strategy and completing some information, which we will discuss in detail in the next session about brokerages, choosing the right brokerage, and this. Though, what factors we need to know and consider when working with a brokerage, and we will talk about them. In addition, what types of trading accounts exist, what are the advantages and disadvantages of each trading account, and based on our budget, what types of accounts we can open or with what minimum amounts. To enter those trades, we need to have those accounts and fund them. And choosing the types of trading accounts and how much minimum funding each trading account requires. We can see what advantages and disadvantages each one has compared to the others when we open an account. We open a trading account. There are a number of factors like the commissions it charges, the spreads that are applied to it, and so on. We calculate all of these together and see which trading account model is better for our balance. After that, we move on to the trading platforms to see the different types. What trading platforms are there for analysis, like MetaTrader 4, MetaTrader 5, TradingView, and so on? Various types of MetaTrader and also other trading platforms. So, in the next session, we're going to discuss all of these topics in detail, one by one. Welcome to the future. We have arrived.